chapter number 6, that is retirement or death of a partner of standard trial commerce subject account. Today we are going to see some, in that sum there is a, we have to maintain the minimum balance of cash, and again we are going to make capital account adjustment into cash account. So after the retirement of a partner, whatever the cash balance, capital balance will be there, that's supposed to be in new profit sharing ratio, and to maintain that new capital, partners is going to brought in cash capital account. So here minimum cash balance is also going to require, and new partnership firm's capital must be in the ratio of profit sharing ratio. So that type of sum we are going to see today. Sum number 23. Sum number 23. EFG are the partners sharing profit and loss in the ratio of 4:3:3. So their old profit sharing ratio is 4:3:3. E retires on 31st/3/15. Balance sheet of the firm on that day was as under. So balance sheet is given to us where we are going to make the adjustment, that is general reserve we are going to distribute amongst the partner, goodwill we are going to write off among the partner, and another adjustment we will see. Now very first thing we are going to find out gain, so that we can find out the amount payable to the retiring partner. So for that, let's find out the, as here new profit loss sharing ratio of F and G is given, that is 4:1. So old profit sharing ratio, new profit sharing ratio, both is given to us. So we are going to find out the gain, and we are going to find out the amount payable of goodwill to retiring partner. Calculation of gaining ratio. So here EFG and their old profit sharing ratio, old share is 4:3:3, and new share is 4:1. Now we are going to find out the gain. So as we know, the formula of gain is equal to new share minus old share. And F's gain is equal to F's new share is a 4/5 minus old share is a 3/10. So here we have to take the LCM. So taking the LCM, 4 2s are 8/10 minus 3/10. So that will be 5/10. So this is his gain. Gain of F. Now let's find out G's gain. G's gain is equal to G's old new share is 1/5 and old share is 3/10. Again taking the LCM, 2/10 minus 3/10. So here we can see that there is a minus negative figure. So it is called sacrifice. So this is the sacrifice. So here F is the one who is going to give the goodwill to G as well as E, because G is also sacrificing for new partnership firm and E is retiring from the partnership firm. So let's find out the distribution of goodwill. Calculation of goodwill. So here total goodwill of the partnership firm is given to us, and that is 4,000. So total F will be paid goodwill of rupees 2000 and E will get 1600 and G will get 400 of goodwill. So this is the calculation of goodwill. Now let's see the other thing. So goodwill is given. Now value of the fixed asset is going to be depreciated by 20%. So here we can see that there are two fixed assets, that is land and building and furniture. That value is going to be depreciated by 20%. And next adjustment is stock is found overvalued by 10%. So here the stock whatever is given in the balance sheet, it is overvalued by 10%. That means if market value of the stock is 100 rupees, then here in the balance sheet it is given 110. So we have to find out the market value of the stock. So for that let's make the calculation of stock. So for that we have to assume 110%, that is the book value. Book value of stock is 6,600. So now we have to find out 100%, that is market value. Market value of stock will be how much? So here 6,600 multiplied by 100 divided by 110. So here we can see that this will be 6,000. So market value of stock is a 6,000. So 600 we have to write off in the revaluation account, and 6,000 we are going to write down in a balance sheet. So here is the calculation of that. Student, you may note down this. Then we are going to prepare revaluation account, partners, capital account, cash account as well as balance sheet. Let's prepare revaluation account, partners, capital account, cash account as well as balance sheet. So here in the balance sheet, on the liability side, very first thing is a capital account. So here is the opening balance of the capital account that we are going to write down on the credit side of capital account by balance brought down, and that will be 8,000, 5,000 and 2,000. Now let's see the next thing, that is a general reserve. General reserve 2,000 is given to us. That's supposed to be distributed amongst the old partner in old profit sharing ratio by general reserve account, and in the old ratio that is 4:3:3. So 800, 600 and 600. Now there is a creditors. So for creditor nothing is given in the adjustment, so we have to write down straight in the balance sheet. Creditors, that is of 8,000. Now next is a bills payable, that also we will write in a balance sheet as nothing is given to us. So bills payable will be 2,000. On the asset side, very first asset is a goodwill, and this is the old goodwill, and it's supposed to be write off amongst the old partner in old profit sharing ratio. So here to goodwill account, and in the ratio of 4:3:3. So that will be 400, 300 and 300. Now after goodwill, the next asset is a land and building, and land and building adjustment number 2 is telling us that fixed asset is to be appreciated by 20%. So the value of the land and building is 6,000 and 20% of it will be 1,200. So total value of land and building will credited to revaluation account. On the credit side of revaluation account, by land and buildings. Account 1,200. Now, other fixed asset is a furniture, and it is also going to be appreciated by 20%. So 20% of 4,000 will be 800. So here we are going to write down 4,800, and 800 will write on the credit side of revaluation account by furniture account. That will be 800. Now let's see next thing is a stock, and for stock we already made the calculation. So value of the stock will be 6,000, and we write on the debit side of the revaluation account to stock account 600. So that. Now after stock, another asset is a debtors, and for debtors nothing is given to us, so straight we will write in the balance debtors of 9,000. Now the last asset is given to us is a cash. Cash will write in a cash account opening cash balance. So to balance brought down 400. So we are finished with the balance sheet. Now let's see adjustment. So for very first adjustment is of goodwill, and for goodwill we already calculated the amount. So let's write in the capital account. So here we have passed the journal entry, that is F capital account debit to E's capital account to G's capital account. So here on the debit side of F capital account we are going to write down F capital account will write 1,600, and here we will write 2 E's capital account, and 400 will be payable to G's capital account. And on the credit side of E and G's capital account by F's capital account, and that will be in the E's capital account it will be 1,600, and in G's capital account it will be 400. So we have made the adjustment of goodwill. Now the next adjustment is amount due to E is to be paid in cash, and cash balance of ₹1,000 in new form is to be maintained. So here we need to maintain cash balance of 1,000 to run the business smoothly. For this purpose, F and G brought cash in such a way as to make their capital proportionate to their new profit sharing ratio. So here new profit sharing ratio is given to us 4:1. So new partnership firms capital must be in the ratio of 4:1. For that we have to calculate the partners capital, and before that let's close the revaluation account and then take to the partners capital account. So here we can see that there is a profit in a revaluation account 2,000. From 2,000 if we are going to deduct 600, so profit will be 1,400, and this 1,400 supposed to take to the partners capital account too. Partners capital account, and it must be distributed in their old profit sharing ratio, that is 4:3:3. Now let's find out E's profit, F's profit, and G's profit. So here for 1,400 this capital account by revaluation account. So here 560, 420, 420. Now we have to make the adjustment for the capital account, and here it is given to us amount due to E is to be paid in cash. So whatever we have to pay to E, that we are going to pay in cash, and we are going to maintain minimum cash balance of rupees 1000. So that for that, let's find out the total. So here we can see that we have to close the E's capital account, and closing that. To close the E's capital account, 8,800, 1,600 and 560. So it will be 10,960. This 10,960. From that, if we are going to deduct 400, so balancing amount will be 10,560. This we supposed to pay to him by cash account. So here we have to ask the other partner to bring the cash, and for that we are going to make the calculation. This cash we have to give to the E. So we are going to write on the credit side by E's capital account. $10,560. And now let's find out F and G's capital account balance. So for that, F's new capital of partner. So here, very first we are going to find out F's capital. So F's capital 5,600, 420. So that will be 6,020. From that, if we are going to deduct this side capital, that is 300, 1,600 and 400. So it will be 2,300. So balancing amount will be 3,720. And let's find out G's capital. So that will be 2,600, 400 and 420. So that will be 3,420. And from that, if we are going to deduct 300, so that will be 3,120. That will be 3,120. And here we have to pay to E in a cash. So payable to A, that will be 10,560. And here our balance is a 400, but we have to maintain a minimum balance of 1,000. So that sort of 600 also partner will bring from the home. So that is shortage of cash balance. So that will be 400 minus 1,000. So that will be again 600. So that 600 also going to brought by new partner. So total of this will be 18,000. So 18,000 will be the total capital of new partnership firm. So now let's find out this 18,000 in the ratio of 4:1. So new capital of F will be 18,000 into 4 upon 5. So that capital will be 14,400. And new capital of G will be 18,000 into 1/5. So that will be 3,600. So now this is the closing balance of capital account that we are going to write down on the debit side of partners capital account. 2. Balance carry forward, and that will be 14,400 and 3,600. Now we have to find out the amount that is supposed to be bring from home by F and G. So here we can see that the debit side total is more for the F's capital account. So that is 16,700. This we are going to take to the credit side. So from this, if we are going to deduct this amount, then the amount brought by F will be by cash account, and that cash F will be brought 10,680. And now if we can see that the G's capital account, we can see that G also the debit side total is a more, and that is 3,900. This 3,900 we are going to take to the credit side, 3,900. From this, if we deduct 2,600, 400, 420, balancing amount will be 480. This is also going to be brought by G in a business. So these two cash will be debited to cash account. 2. F's capital account. 2. G's capital account. And here 10,680. And here 480. So total of debit side must be 11,560. And this, if we are going to take to the credit side, 11,560 by balance carry forward. So that will be 1,000. And this 1,000 we are going to take to the balances. Balances cash of rupees 1,000. And here we are going to write the balance of capital account of F and G. So capital account F and G. So that will be 14,400 and 3,600. So total capital will be 18,000. Now let's make the total of the balance. 18,000, 8,000, 2,000. Total will be 28,000. Total will be 28,000. Here also it must be 28,000. So student, you may note down this